Very interesting action in the COT report. It's a little bit different what you may see, but it does explain why the short pressure on both of the commodities as we head into the fall. I don't think that's going to last forever, because I think eventually, given the economic problems, gold and silver will rise, but probably we're going to get a sell-off first, head into recession. So gold and silver may fall a little bit this fall until we get some negative news, and then they shoot back up. If we go into recession, gold and silver will fall for a certain period of time, probably a couple of 3 weeks, maybe even a month, before shooting back up in a big way.
RobertKientz is a prominent figure in the world of precious metals, serving as the editor and publisher of GoldSilverPros.com. Kientz believes that gold and silver may experience a slight decline for a month before rebounding significantly. Gov Capital, another algorithm-based forecasting service, issued a silver price prediction stating that the metal would close out 2023 at a potential average of $27.895. The platform sees silver rising to an average of $57.534 by the end of December 2025, $80.471 by the end of 2026, and $97.648 by December 2027. Robert highlights rising trading activity in silver as October deliveries near, particularly noting a shift in exchange for physical EFP numbers. October contract silver and gold first-day deliveries are a near clean sweep, with non-banks doing all the selling and bankers doing most of the buying. Plus, 11 ton of gold transfers out of registered at MTB's vault, dropping comex total by 3.2%. Robert shows his concern regarding the declining number of silver contracts going to London, but he underscores the ongoing strength of industrial demand for silver. Demand for silver from photovoltaic cells, PV, which make up a solar panel, has shown a threefold growth since 2014 and is expected to reach 161 million ounces in 2023, according to the Silver Institute. Robert suggests buying gold and silver now at lower prices, as they typically increase in value during economic crises. Gold and silver prices both fell to their lowest levels since March. Gold slipped by close to 1% to about $1,848.45 per ounce, while silver prices tumbled by about 4.56% to $21.43 per ounce. Now, we are presenting the clips of Robert Kientz's insights from his recent video. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Moving over to silver, looking at the volume and open interest on the day, we've got elevated through the end of September as we prepare for deliveries in October. We've had 124 deliveries on the October contract. But look at where we are in exchange for physical. 775 contracts as of Friday's data of 5,000 ounce silver went over to London. On Thursday, it was 250 contracts. On Wednesday, it was 906 contracts. On Tuesday, it was 790. And on Monday, it was 227. Now you're seeing less contracts of silver go to London seeking out the physical. One reason is because each contract in silver is 5,000 ounces, whereas each contract in gold is only 100. So you need less contracts to control silver. While industrial demand is very heavy in silver, the monetary demand for gold is off the charts, which is why you're seeing high exchange for physical numbers each day, because people are going to gold. Why do people go to gold? Gold is the almost purest play for when you go to a recession and you think there's going to be currency problems, you think there's going to be economic problems, everybody rushes to gold. It's the biggest safe haven. Silver, for the most part, most of the time trades as a commodity used in all the things that we use: technology, military, medical. And then silver will jump up when people treat it as money. Right now, gold is leading the way, which tells me risk is on in the market. People are afraid and they're going to gold big time. And I think because the swap dealers think that gold is going to go long here in the future, so they're adding longs and cutting their shorts and moving those over to the managed money. Right now, the managed money is going to make a little bit of money on the trade, but I think what's going to happen is swap dealers are going to flip and go back to shorting gold so they can get the gold off of the market. But as long as they have enough short positions in there, they can get the gold off of the market cheaply. Over in silver, as we move up into the silver section of the report, this is silver. We see that the swap dealers went additional short 2,374 silver contracts, while the managed money released those. So basically, managed money went net long, swap dealers went net short. That's where the shorting in the silver is coming. I believe the swap dealers are shorting silver to keep it from rising too much, primarily for industrial reasons, but also because if you keep silver down, that keeps a lot of investors, a lot of silver stackers frustrated at the market. and it keeps that silver flowing to industry at cheap prices, which they need. We're in silver shortage condition. Overall, the mines cannot produce enough, and I think that's what's going on. This time that we have right now, and until we have the big economic collapse that I think is coming, if you're interested in the metal to buy your metals, you're going to have lower prices. And don't get frustrated, because as long as you're keeping enough cash liquidity in the bank to cover your bills, you don't have to sell that gold and silver right now. You don't have to worry about lower prices. It's an opportunity for you to get in. But remember what happened in May of this year when we had bank failures, gold and silver, boom. Remember what happened during the pandemic in 2020 when we had shutdowns, gold and silver, boom. Remember what happened in 2008, right after the 2008-2009 recession, from 2009-2011, gold and silver, boom. What happened during the tech crisis in 2000 when we had the sell-off in the tech sector, gold and silver, boom. It happens every time we get into one of these economic crises. I think everybody believes we're going to economic crisis, or gold and silver will rise. Don't get discouraged in that trade. That's my recommendation.
RobertKientz suggests that while paper trading may show a bearish trend, the underlying demand for physical gold remains strong. GoldSeek.com recently posted on Twitter, "In gold, we are on day 4 of a 5 to 7 day bloodbath phase. This produces a huge multi-week rally that I am convinced will give us the breakout above 2090. Furthermore, Robert observes rising trading volumes in gold as we move into October, typically associated with upcoming deliveries. At the end of Q3, third quarter, on September 29th, the price settled over 5% lower at $1,866.10 per ounce, $99.90 below the level at the beginning of the month. In October 2nd, the price was lower at the $1,850 level. Gold looks ugly, but the long-term trend tells us the bull market is nowhere near over. Let's get back to the interview.
Gold is down $18 to $1830.39. Silver is down 93 cents to 21.18. Getting a lot of interest in gold and silver in my store today as the prices have started falling. We're going to get into the charts and tell you what's going on specifically with gold and silver. On the gold chart, as you can see here, elevated volume here to begin to end September and to begin October, which is normal because you're going to have some deliveries in October. But overall, the interest is up as the price falls. That tells me more shorts are entering the market. We'll get to that in the COT report here in a moment. But looking at deliveries here, the October month, we've already had 3,337 deliveries for Friday, September 29th, one of the first delivery days. I believe for the month, we're up to almost 4,000 and some deliveries on the month. We can also see that the exchange for physical over to London from the December month, where you can't deliver currently in the December month, but you can take that COMEX contract and go over to London and see if you can get delivery there, is at 5,164 for Friday's data. And I like to do this over multiple days to show you there is a crap ton of demand moving from COMEX to other markets, because not every month on the COMEX is deliverable. About 6 months are going to be somewhat heavy delivery in gold and in silver every year on the COMEX, about half of the months, even though the paper trades all the time. So in a light month like September, October, November, which have lower overall open interest, as you can see the numbers here, what's going to happen is people are going to take their COMEX contract in the big futures month, December, try to pull it forward a couple of months and see if they can get delivery here in October. So if we look at Thursday's data, we had an additional 7,266 contracts of 100 ounce gold move over to London. We look at Wednesday's data, we're 11,464. That is one of the largest prints I have seen all year on a single day. 11,464 gold contracts are being pulled off of the December COMEX market into London, seeking physical delivery of the metal. They want the physical. The market wants the physical now. 7,865 last Tuesday. Last Monday, 6,993. An immense amount of demand for physical gold is going on in the markets. I cannot possibly stress that enough. You can only get a modest amount of deliveries in a month where it doesn't have a lot of contracts, but you can take it over to London fishing for that gold. Let's look at the settlement data. As of Monday, 1:32 p.m., you'll get that midday quote. It's why I wait to do this market wrap up until after that quote, because we can see what's going on Monday. And the December contract is a dominant one. You can see a volume of 181,000 contracts. For those that have never watched the market wrap before, what that means is this is a futures market. They're trading the potential future prices. So you'll take a futures contract to a futures month or a contract to a futures month. And while you take delivery only the current month, you're playing the prices several months out because you're trying to offset risk if you're a producer or merchant of dealing with the physical, or if you're a speculator, you're just trying to take money on what everybody else is doing take a position and try to snipe that or take some money off of that on a futures contract in the future. So we saw that gold is down $18.90 today on early trading. Of course, it's done a little bit better here after 1:30, but overall very bearish on gold. That's why the slam down. Going back to Friday's data, that was down $12.50 on the December contract. And on Thursday, it was down $12.30. And on Wednesday, it was down $29. And on Tuesday, it was down 16. So all of last week was incredibly bearish on the gold market. Now, remember, the futures market is where the prices are determined, not the physical trade. The futures market. So this is paper trading, not the physical. So it's not indicative of the overall physical demand. I just told you where the physical demand was very high. People are trying to get gold. A lot of times to cover that physical demand, the shorters will come in and short the market to keep the prices down, so then they get that physical very cheaply.
Despite temporary bearish trends in paper trading, the enduring demand for physical gold and silver strongly indicates their resilience as precious assets. While Robert Kientz observes that swap dealers are strategically shifting their positions in the gold and silver markets to benefit from future price movements. How do you see the role of gold and silver evolving in the face of economic uncertainties? Share your thoughts in the comment section below. If you find this video informative, don't forget to show your support towards our channel by giving this video a thumbs up and subscribe to our channel, and turn on notifications to stay informed about our latest videos covering more exciting topics. Thank you for watching.